Good afternoon and a very warm welcome to third leadership conversation organized by RBSA. This is a desperate time for India and entire world. Even before COVID, the Indian economy was showing signs of weakness, both in terms of demand as well as industrial output. The banking sector, which is the spine of our economy, had already been bruised due to severe blows, including ILNFS, DHFL, Yes Bank, and many more. It is most likely that this may be further impacted due to COVID catastrophes. How will the banking sector emerge from this unprecedented phenomena? How do we resolve distress in this new normal? To decode some of these intriguing queries, we have with us Mr. Sunil Srivastava, retired Deputy Managing Director of State Bank of India, and Mr. Samuel, Deputy Managing Director with IDBI Bank. Mr. Srivastava is a career banker and has retired as DMD of the Corporate Accounts Group at SBI after serving about 38 years. During his last assignment, Mr. Srivastava was actively involved and spearheaded on behalf of the banking industry the resolution and recovery process for most of the large corporates, both pre and post NCLT. He has spent a major part of his career at corporate banking at SBI, a bit on investment banking at SBI Capital Markets, besides a 5-year stint at New York office, which offered him an exposure in the international banking. Sir keeps on writing credit-related issues in the banking industry and is a familiar face on the business channels in India. He can be followed on his blog, theindianbanker.in. Post-retirement, Mr. Srivastava has been engaged as a senior advisor at Edelweiss, besides being engaged with the World Bank as a senior advisor for their energy and extractive programs in India. We have another eminent speaker for today, Mr. Samuel. Sir is currently serving as Deputy Managing Director with IDBI Bank. He has about 27 years of experience in project and trade finance. He was in charge of loan recovery, treasury, accounts, IT, and HR at Exim Bank before resuming his charge with IDBI Bank as DMD. Earlier in his career, he was also taking care of corporate banking group, including SME and agri-finance. He was also heading London and Milan branches of Exim Bank. Mr. Samuel is a regular speaker on banking, trade finance, SME banking, on various conferences and led various consultancy assignments in many countries on behalf of Exim Bank. He was a member of Task Force on a financial solution for research and development in the pharmaceutical sector, set up by Ministry of Commerce and Industry, Government of India. He is also a member of BRIC Rating Agency Expert Group under the aegis of BRICS Business Council. Sir has represented Exim Bank as a nominee director on a few corporate boards. Presently, he is representing IDBI Bank on the boards of IDBI Capital Markets, IDBI Trusteeship Services Limited, and IDBI Mutual Fund Trustee Company Limited. I welcome both the eminent speaker for today's session. As a co-moderator of the session, we have with us Mr. Pradeep Kumar Sethi, who is also a veteran banker and spent about 33 years in the banking industry. Sir is heading investment banking division at IDBI Capital Markets before joining RBSA. He has started his career with State Bank of India and later on joined IDBI Bank. Most of his career has spent into corporate finance. He is also an insolvency professional and currently heading our restructuring vertical at Mumbai. On behalf of RBSA and all participants, I once again welcome our distinguished panelists and looking forward for a great session. To begin a session, let us try and understand the health of a banking sector first. Pre-COVID also, the banking sector was struggling with major shocks, including ILNFS, DHFL, distress in real estate, stress in NBFC, power sector logjam, etc. Mr. Samuel, can I request you to provide us the overview of the health and balance sheet strength of the banking industry system, both before COVID crisis and how COVID has made things worse for us?
Ali, you're right in saying that we were already reeling under a slowdown and the bank's balance sheets were already stressed. There was a gradual reduction in growth rates quarter on quarter of GDP itself, and it was reflecting on the bank's balance sheet even before this COVID. But after this, the economy has come to a complete standstill. And in my view, the bank balance sheets will be stressed further. But if you ask me, are we doing enough as a country, meaning the RBI and the government? I think we are taking necessary actions. You mentioned about specific instances of Island FS, Yes Bank, DHFL, so on and so forth. Post such crisis, the NBFC sector has been reeling under a liquidity crunch. And even before the COVID itself, RBI has taken various measures to improve the liquidity of the NBFC sector. And to a large extent, I will say the liquidity problem in that sector has been addressed. We had the TLTROs. After that, the mutual fund sector, which came under pressure for liquidity, we had the SLF, MF schemes. And even now we have the partial credit guarantee scheme. So we are doing various measures to address some of the concerns what you had mentioned. But as far as the impact of the COVID on the bank's balance sheet, I think we will see further stress going forward. As to what that number will be, it is anybody's guess, because even today we are in the midst of the storm. The storm is yet to cross, and only after that we can assess what's the damage and how much time it will take for us to repair the damage.
Sir, I fully agree that RBI is taking enough steps to control the distress. But at the same time, sir, the NPA is actually a troublemaking for banking industry. Even before COVID, the banking industry is grappling about 9 lakh crores of NPA in the system. And today, everyone is much concerned about the probable increase in the deterioration of the asset quality in the light of this pandemic. A recent Fitch report also states that NPA will likely to soar by 6% in coming 2 years. What is your take on this, sir? Samuel, sir? Do you think that the Fitch report or market per se is very, very pessimistic?
In today's scenario, I don't know whether anything can be very pessimistic, because we really don't know the depth of the problem. While it appears pessimistic in the first look, I will say that nothing should be ruled out. Rather, I will not say that it is a definite possibility that it will shoot up by another 6%, but we shouldn't rule it out either, because we are, as I said, we are still in the eye of the storm. The impact of this, whether this will create some long-lasting structural impact on the economy itself, is still not very clear. So we shouldn't rule out a 6% increase or even higher. Recently, in fact, internally, when we were discussing some best case scenarios and worst case scenarios, we were just saying, thinking that even the worst case scenario could become a reality after all. The way things are going. Some of the measures that we have taken, for example, this moratorium, 3 months, 6 months, so on and so forth. Now, for every sector, this cookie cutter approach or a one size fits all approach may not be the solution. There are certain industries which have been deeply impacted, and the impact will be there for a very long time. So for those sectors, maybe this moratorium approach may not work. And coming specifically to your question on whether 6% is too pessimistic, I think we should be prepared for the worst now. And prepared in the sense, we should have capital buffers to absorb these risks. It is better to raise capital and keep it idle even now, and even to sit on extra liquidity. Though Reserve Bank has reduced the liquidity coverage ratio from 100% to 80% temporarily, I think most of the banks are carrying on excess liquidity in the system, because we really don't know. On a bad day, it is better to carry extra capital and extra liquidity as well. So my answer to the question is, we don't know whether 6% is real, but it's better to be prepared for that.
Thank you, sir. Srivastava sir, what is your take on this, sir?
So the last question, you were talking about the effect of the COVID and the NPA situation. Well,
Yes, sir.
it is yet a very uncertain prediction, but even at the present level, with the demand compression and the supply side constraints due to either labor, logistics, or liquidity, whatever measures we have taken may not be enough. Because we have to understand that the economy has to be operated holistically. So by attacking various segments of the economy at separate times, you are not going to solve the problem. And unless we have the vaccine or the visibility of the introduction of a vaccine, there can be no certainty in the system. And during which period everybody tries to conserve cash. So while some businesses have been restarted, obviously because of demand compression, they will obviously conserve cash and conserve liquidity, which is natural, nothing unnatural about it. During this period, unless there is an investment cycle which is kick-started through heavy lifting by the government, the demand side will not revive. And therefore, I agree with Mr. Samuel Joseph that 6% I think would be very, very optimistic. Going forward, I would assume that there would be failures at the bottom of the pyramid, definitely, and in the MSME sector. Some of the larger players may be able to survive, because if you see that if you analyze the balance sheets of various corporates, you will find that the top level corporates have a current ratio which is almost, they work on negative net working capital, which means that they are beating their working capital requirements through extended credit extended to them by their suppliers, and that's the value chain down the line. Now, if that value chain is not broken, from the government paying its dues to the larger corporates to the middle, and middle to the small, and small to the absolute suppliers, you will have this problem of disruption. So 6% is a very optimistic figure as per me. I would say that we would be higher than that, and we need to be prepared for that.
Let's hope so, sir, that we can able to restrict it to 6% or even lesser. Yes, sir. Samuel, sir.
No, just a comment on Mr. Srivastava's comment. Apart from the numbers, I think he touched upon two very important things. The core of the problem that we are talking of. One is the demand compression, which industry is facing, and the other one, more importantly, is the working capital cycle, which has got elongated. And we don't have a clue as to when this working capital cycle will get normalized. So the crux of the problem for normalcy to return to industry and to the bank balance sheets will be when both these problems are solved in one go.
True, sir. So currently, for every economy in the world, the revival of the economy is a challenge, probably a key challenge. And every country is trying to control their NPAs, and so India has. So last week, the ordinance stating suspension of IBC process for the accounts which will turn NPA on the 25th March or thereafter in this year for a period of 6 months. Srivastava sir, given our current unprecedented situation, what according to you should be our strategy in dealing with this distressed debt? Will it be IBC, or will it be June 7 circular, or will it be ICA in some new avatar? What is your say on this, sir?
So actually, I've written an article on this on you see, when there is uncertainty, there is fear. And at the moment, nobody can predict as to when will this COVID crisis end. But what is predictable is that you will not have a vaccine for up to December. Now, if that is predictable, at least you can impart certain certainty up to December. And at the same time, if the IBC process is really not going to solve, this is the unprecedented situation. So suspension of the IBC post March 25th is a very, very correct thing to do, because you can have defaults which are, acts of God, force majeure, or whatever you call it. Now, during this period, if you need to, it's not only necessary to make these companies survive right now. And for them to survive, you'll have to take care of not only moratorium, but also to give them liquidity to restart their business as and when you start opening up. And the third thing, and most important, is for the period of this uncertainty, which is definable at the moment, say up to December, you must allow the restructuring of the dues for at least 3 to 5 years for these companies to get back. Now, this is what I've written in my blog, that all these three aspects will have to be handled simultaneously. You can't do it on a piecemeal basis, that March, April, May, and then June, July, August. That is defeating the entire purpose, because it's creating more uncertainty. To the extent that it's possible for you to create the certainty and reduce the fear with the gradual opening up and giving the restarting capital by way of the National Credit Guarantee Trust funds, I think that's a very correct step to do. So strategically, these companies, there would be no takers. Even if you take them to IBC, who will buy them? After the first 12 cases, even in the first 12 cases, we have a few companies which have not been resolved. So you are talking here in terms of 65 lakh MSME units, out of which even if 10 lakh fail, I'm talking about 10%, 6.5 lakh units at whatever levels. How do you resolve them? You can't produce entrepreneurs in a day's time to replace those 10 lakh entrepreneurs. So at some point of time, we have to get real. And I would highly recommend that, yes, let us recognize the certainty that there can be no vaccine at least up to December, and plan accordingly. If the vaccine is introduced before that, the companies which we are supporting or the units which we are supporting will become stronger. There is obviously a thing that this can be misused. But how much can be misused? The stronger ones will conserve capital. The middle ones who require capital will use the capital. But the lower ones who have no chance of survival with this infusion can at least have half a chance of survival. Now that is much better than your entire system going to be, making you provide for more capital from the government or infusion of otherwise. So that's my view on that.
Thank you, sir. Thank you for sharing your insight. Sethi sir, can I request you to take it forward from here?
Yeah, sure. So my next question is linked, of course, partly has been answered by Srivastava as well as Samuel sir. But still, a little more clarification on that. See, we know that RBI announced the moratorium, that extension, first 3 months, then again by another 3 months and all that. And do you feel that this is moratoriums are an effective solution to the problem? Can we expect another 3 months extension, or what happens after that? And is it feasible to have something, or it should have in a case-specific approach, depending upon the requirement of each unit, giving them restructuring according to their cash flow requirements, matching with that, rather than giving a one solution fits all, like was mentioned earlier. So, what should be the right approach to this?
You're asking this question to Mr. Samuel or to me?
Yeah, my question to you, sir.
Achha. So I have very strong views on this. So please excuse me for my
Please, sir.
being slightly radical in this. By giving this 3 months of moratorium and expecting them to repay in the month of June, I think this was highly unrealistic. Extending it by another 3 months and then giving them another 6 months to repay without being sure of when the economy will revive, given that the fact that we have had a low GDP in the last year and absolutely negative GDP this year, is again highly unrealistic. So moratoriums by themselves will not have any impact. Now the issue is that why are you not allowing the restructuring? This is an exceptional case. In 2014, if you refer to the RBI circular, there was a one-time restructuring allowed, given the economic problems being faced in the country.
Correct.
Here, it is a national problem. It's not an economic problem. It's a public health. It's a public economy problem. So I don't see any reason why we are not introducing the one-time restructuring. Now, the argument given against that is that you do not know the projections for the future, and therefore you will not be able to restructure the economy. My counter argument is, does the RBI or does the government of India know what GDP growth will be there, or what will be the fiscal deficit? If that is not the case, all the companies which were standard assets or even SMA 1 as of, or SMA 2 as of 29th February should automatically be restructured based on their past performance, not on the future. In the United States, nobody gives money on the future. Future is a pie in the sky. It's a pipe dream. The simple, and Samuel will bear me out. He's worked in Milan. It's based on your EBITDA level. So you have established their viability. You have the entire conduct of their account for the last 1 year. They were standard, or they were not NPAs as of March 1st. I think there should be an automatic thing. Now, the next other thing which I'd like to add here is that this can't be done selectively. In a country, as I mentioned, the economic system is very integrated. Now, if you are giving money to one and not to the other, you are creating an imbalance in the integration. The value chain imbalance is created. And given the fact that our entire public sector banking system is in a sort of a deer in front of headlights, where risk aversion is paramount, I think what Mr. Rajneesh Kumar has done by extending it from the back end is the correct way to do it. Give it across all companies except those which are NPAs and which have been impacted by COVID. How wrong will you go? 5%, 10%? If you don't do it, you're going wrong by around 60%. So at some point of time, you have to be more realistic and rational and take a call. Now, I'm really surprised. I'll give you in this National Credit Guarantee Trust, 17,000 crores of sanctions have been made against a provision of 3 lakh crores, out of which around 11,000 to 12,000 crores has been done by SBI, the rest by all the other public sector banks, and out of the disbursals of 8,000 crores, 7,000 SBI, and the rest by all the public sector banks. Now, when this is a guaranteed facility, why are we asking our people to actually go and discern between what is the cash flow, what is the projection? Because it's impossible. Can anybody project for the future? Today, if I ask Mr. Samuel Joseph, what will be your balance sheet sizes of March 31st, 2021, I'm sure he will not be able to do it. State Bank of India will not be able to do it. RBI is not able to do it. The government is not able to do it. So let's now go from distrust to trusting our borrowers who have proven themselves in the last 1 or 2 years, and we will not go terribly wrong.
Thank you, sir. My next question is slightly different to Mr. Joseph. Sir, it's on the interest rates, repo rates. Yesterday, SBI announced a reduction in MCLR by 25 BPS, effective from tomorrow, 10th June. And it has also said that it will pass on 40 BPS reduction in the repo rate to those accounts which are linked to the external benchmark or are repo linked. But it is generally believed or highlighted by public, people are always saying that no, banks are not passing out to us the full interest rate reduction and all. And like last year, repo rate had come down by 2019 by 135 BPS. But similar fashion, probably the weighted average lending rate had not come down. So can you please throw some light on this aspect as to why the policy rates transmission is not exactly in the same manner as the repo rate reduction or those indicated rate reductions are there? To Samuel, sir.
Yeah. Okay. First of all, just to set the context, I think we are living in very strange times now. I'll answer the question a little later. See, today, deposit rates, term deposit rates are lower than savings bank rate. I don't think we have ever seen this. Even for some tenor, deposit rates that the banks offer are lower than the GSEC rates. Now, in which economy does the government borrow on higher rates than what the banks are willing to pay to the depositors? So these are very unusual times. There is so much liquidity wash in the system. about 8 lakh crore was put in reverse repo at 3.4 that time, and 3.35 percent now. Now I think it has come down to about 6 lakh crore. With so much liquidity, again, banks are the interest rates what we are seeing in the economy are very unusual. That's the context that we are in today. Coming back to interest rate transmission itself, I think this repo linked rates or external benchmark linked rates, interest rates were stipulated by RBI only for micro and small first, and what we call the retail assets, the home loans, so on and so forth. Even there, it was only for the incremental fresh home loans being sanctioned. Existing customers had the option either to switch over to these external benchmark linked rates or carry on with the old MCLR based rates. After that, it was made applicable to the medium industry also, but a majority of them are still in MCLR regime. If you look at the majority of borrowers, the corporate credit is still linked to the MCLR. And just because repo rate is coming down, the average cost of funds for a bank does not come down immediately. It takes time. So I will not agree with this argument saying the transmission of rates has not been free or has not been immediate, or bankers are withholding the benefit. It is not so, because it takes time for the average cost of funds to come down. And the same way, even when rates go up, the average cost of funds for the banks will go up gradually. So the hard-coded formula for MCLR calculation will only perk up with the time lag. Whereas now, what this repo linked rates, what has come into force, the way it has come down by 135 basis points in 1 year, could also go by 50 bips or 75 bips in another year. So that time also the transmission is going to be much faster. I don't know what we will answer our borrowers at that point in time. So it hits both ways. So I don't completely agree with your statement that banks have been withholding this interest rate transmission, because that's the way the system works.
Thank you, sir. My next question is to Srivastava sir. This is on the recent fiscal stimulus. So, Mr. Uday Kotak, the new president of CII, has recently yesterday stated that demand side push is needed to revive the economy. The fiscal stimulus from the government seems to be more focused on the supply side. What could be the possible thinking of the government behind this thought process, this strategy, to focus almost exclusively on the supply side and hoping that demand will take care of itself? Sir, your views of this. Srivastava sir.
So we are a nation of 1.37 billion people. And while our demand may be abated for a little while because of the fear that we don't go out and go into the malls or see the shopping or etc. But if we go to the rural areas, I was talking to the Hero Honda people last 4 days of the last week. 5,000 motorcycles were sold by Hero Honda across the country every day. Now, that may be on account of pent-up demand, or it may be on account of marriage season and the dowry that is associated in eastern parts of the country, that's the river. So that may be exceptional. But the fact is, your demand is not going to vanish in this country. It's a question of how do you, supply side has to be, of supply side for obvious political reasons, supply side has to be. Now, the government has two options. One is to monetize its deficit, use the reserves that the RBI has, or print notes, or open up the FDI. Now, the government has taken the route of we need to provide employment, so let us open up the FDI, and that's the Atmanirbhar Bharat. Now, Atmanirbhar Bharat doesn't mean you use only Baba Ramdev's products and not Hindustani Unilever. It means that Hindustani Unilever, if it produces in India, you buy that. So it's not a call for using Patanjali. It's not an advertising call for Patanjali. But then who will come in right now? You see, as I was speaking to a few lawyer friends of mine, and the inquiries that they are getting from companies abroad to come to India is very, very high. They just need things to stabilize the COVID to end. Because in manufacturing, either you're close to the raw material source or you're close to the market. Now, if you leave out China, which is the largest market in the world right now? India. Now, India, you cannot, for COVID and other reasons, you are keeping it, the demand is abated. But can the demand continue to be abated going forward as well? Now, to kickstart the economy before the foreigners come in, they would like to see what the government of India is doing. And that's where Mr. Uday Kotak has made a call that the government of India now needs to kickstart the cycle, investment cycle, because the private sector will always follow the government. And that I'm sure the government is on the card. If you listen to what Mr. Gadkari says, or a few other pronouncements on the gas pipelines, or I don't know whether you're aware of the one sun, one world, one grid, PM's pronouncements, etc. Now, the issue is how do they fund it? Mr. Samuel and other public sector bankers, they are sitting on 6 lakh crores. And the deposit will continue unabated, even if they reduce the rate to 2.5% for the savings bank or 2.75% for the fixed deposit. These monies are moving out of private sector banks and SFBs and cooperative banks and RRBs into safer havens. So this deposit will continue to rise. So at some point of time, the government of India will have to leverage either through the banks or through opening of the economy to kickstart the demand cycle. So Mr. Kotak is not wrong there. Unless that starts, you will not have the cement or the iron and steel or the logistics or the trucking, etc., or the labor, etc., following suit. So that demand, and I'm sure as we speak, there are more intelligent people in the Prime Minister's office. They will be working on such a mechanism, and we should be expecting to hear this in the next month or so.
Great. Sir, thank you. The next related question to that is, as you said, to increase the investment, the government has to spend more, government has to spend more, government has to borrow more. So there will be increased market borrowings by the government. And the budget had estimated the net government borrowing will be something like 5.4 trillion rupees, which the government has now increased to 9.4 trillion. So borrowing limit as percentage for similarly for states would also go up as a percentage of GSDP. So, so it's generally believed that the banks are little cautious in lending to the private sector. So, do you think that with the increased focus by the enhanced borrowing program of the government, this will chase away the private sector borrowing? So, the investments are how do you first to you only, then we can take the views of Joseph sir.
So yes, the government borrowing is going to crowd out, but as I mentioned, this is a natural process. The private sector investment will only follow the government sector. So there will be a crowding out. The banks would definitely go in for these D6, and they have had a field day on the treasury because the yields have been going down and they've been booking profit. But they should also expect a similar reversal if the entire money is going to go into the D6 only. At some point of time, the cycle will turn. So that they should be prepared for. But that is essential. Now, I'm not saying that the entire money will be used for that. There are creative ways of not using the money, yet building your infrastructure. That's another blog I have written. I'll encourage you to read that. That's a creative way of not using the money in the banking system, not borrowing, and yet building your infrastructure.
Interesting.
So, so there are ways of doing it, but that investment cycle has to be kickstarted by the government. There's no denying it.
Joseph sir, your views on this? Whether
No,
it will lead to overcrowding or the...
No, I completely agree with Srivastava ji. Government borrowing, that too when it is going up by almost 80% from the budgeted estimates, will definitely crowd out private sector borrowings. But what is the choice today? There is no other option. In the first place, there is no demand from private sector corporates to raise borrowings today. For that demand to come, I think the government has to take the first step, pump up investments, pump up the economic cycle, and then the private sector will come. So without this incremental borrowing, trillion rupees, I don't think we will ever see the economy reviving, the investment cycle picking up, and then ultimately the private sector stepping in to borrow and invest. So we don't have a choice today. It is best not to talk hypothetically. There is definitely a crowding out impact, but there is no choice but for the government to start the economic cycle by investing more. So there is no other choice now.
Thank you, sir. I take a pause. I request Mitali ji to continue.
To continue our discussion on Atmanirbhar Bharat, sir, I think we were also discussing MSME, and Srivastava ji has just mentioned that we have about 65 lakhs MSME in India. So, sir, this MSME can actually play a critical role on revival of the economy. And I think that is the reason why government has given enough weightage in the stimulus package, and about 3 lakh crores has been, disbursed to MSMEs without any collateral. Samuel, sir, do you think that this is a good step? And are we not going into the era of unsecured funding? Sorry, sir, we are not able to hear.
Sorry, sir. Yeah, for some reason my mic gets switched off automatically. No, I was just saying, difficult times call for very difficult answers also. And we are not in an ordinary time to be purists in either our economic policy or even banking regulation. We are in extraordinary times and we need extraordinary measures. While in principle, such a thing of government underwriting private sector credit, and that to 100% principal and interest, causes distortions in the economy and could cause moral hazard as well. But given the situation that we are in, where liquidity is awash, but banks are risk averse, the risk perception, I will not say completely risk averse, but the risk perception is very high today. So to break this, I think this was the right thing to for the government to be doing. So given the situation that we are in, I think out of this whole economic stimulus package that has been put, while majority of that has been trying to address the non-existent problem of liquidity, I think this 3 lakh crore, to put it correctly, has addressed the risk aversion space, and hence it is the right thing to be doing.
Srivastava sir, do you agree with what Samuel sir is suggesting?
Yeah, I think I answered this question in my earlier, one of the earlier questions, that 3 lakh crores has been given to the government, but it's to the National Credit Guarantee Trust. So there are two issues I am told. One is that what is the risk weightage for this exposure, which is going to be backed by a trust guarantee and not with a government guarantee. I'm sure RBI and the government would be finding a solution to that. The second question, of course, second part, of course, is out of the 3 lakh crores, while it has started, as I mentioned, only 17,000 crores has been sanctioned and only 8,000 crores disbursed. So obviously, if you leave it to the discretion of the bankers to provide this emergency relief, it is again going to be a measure which is doesn't, effective implementation will be an issue. So as I mentioned earlier, I would commend what Chairman SBI has done and made it effective from the back end. And the back end, the branch is only supposed to give the sanction letter and get a document signature on the document and provide the money. So they are not going by taking projections, and because it's impossible to take projections. So all accounts which were standard assets as of March 1st, they have made this offer. Some may need it, some may not need it. Some may use it to run down their costlier assets. Very good. But anyway, the banks are having a 4-year term, term exposure rather than a cash credit, which is more volatile. So it suits the banks as well. But unfortunately, I don't see the other banks following it, and therefore, I would have expected that this would have been much faster. Perhaps there would be a rethink on this matter with the other banks, and they will emulate what SBI has done.
Thank you, sir. Srivastava sir, PSU banks have been so far a financial backbone of the Indian economy. How do you see their role is getting changed or expanded considering the present crisis?
So 10 years back, in a FICCI conference, a CIA conference, I forget, there was a paper read by BCG which had sounded the death knell of public sector banking. They had given them a life of 5 years, that public sector banking would vanish in this country. I have not met the BCG chairman, but when I meet him after the vaccine, I'll certainly ask him as to who is now supporting the country and what is the backbone of this. So the PSBs had been written off several times, but if you see the experiences of the banking sector in Argentina and Chile, it is important for the bank of the country to be self-reliant in its banking system, and that's where the public sector banks have come out and have proved themselves gloriously. The fact that these branches in remote areas are opened by all public sector banks is a phenomenal thing. So here I would say that they are the COVID warriors. And if you look at the banking sector in this country, you have the foreign banks which have withdrawn in a shell, the private sector banks which have given indiscriminately to unsecured lending to the retail, now going to be fearing the worst of the COVID crisis, and the public sector banks which had been berated that they have been venturesome and they have given money indiscriminately, etc., are coming to the rescue of the same population of this country. So the public sector bank will remain in this country. Maybe 4 or 5 large banks will remain, the others will be merged, but then you will have a stronger banking system. But you cannot have a banking system in this country without the backbone and the support of the public sector bank.
Very true, sir. From time to time, public sector banks are taking initiatives to meet the crises which are arising in India. And I recollect that last year, the Indian Bank Association has taken such a step by introducing a concept of agent specialized monitoring with an objective that this will monitor the assets post sanctioning of the loans. Lenders have to appoint the ASMs for borrowers who have a large exposure in the banking system. And appointment of ASM is also emphasized by Ms. Nirmala Sitharaman during her budget speech in February. Samuel sir, do you think that this measure will actually help the lenders to control NPA or to have a better control over accounts, finance, and business of borrowers? Sorry, sir, we are not able to hear you.
Yeah. No, this will help. A specialized monitoring agency to monitor the cash flow specifically will help, because earlier there have been some instances of diversion of funds to group companies or outside the business, so on and so forth. But my view is a little different. Your specific question, will this help in reducing NPAs? Presumes that all NPAs were caused because of fraud or diversion, which is not the case. I think a large amount of NPAs in this country have been because of business cycle. Reallocated a resource after allocating it for instance, coal mine deallocation or spectrum problems, what we saw in the telecom sector, so on and so forth. So all NPAs have not been because of bankers sleeping or promoters having siphoned off the money. All NPAs, a few NPAs would have been there. So to that extent, this will solve the diversion problem or some fraud issue. But this brings in better discipline, at least in the initial years when some other agency is looking at the cash flows, why this amount has gone to a company. So it brings in about oversight. But in the long term, I think internal systems, because policing can take us only that far. A mature economy or a mature society, policing has to be minimal. How much can you police your borrower, or for that matter your neighbor, or for anybody else? So limited way, yes, but long term, I think our society has to mature so that these mechanisms are self-regulatory in nature on and not imposed by the regulator or by the lender.
Thank you, sir. Thank you for sharing your thoughts. So if we wish to discuss, some of the effect
Mitali,
of... Yes, sir.
Mitali, can I come in on that question to supplement what Mr. Samuel
Sure, sir.
mentioned?
Please, sir.
You see, the incidence of gold plating or over invoicing has been a fact of Indian industry from days ad infinitum. But the extent of over invoicing or gold plating is not to the extent that is being brought about. Now, definitely in the earlier system of project financing, and Samuel would have done it in the earlier days, we used to get competitive quotations and then check up from the manufacturer and confirm that these are the same specs and these are the cost and competitively and why he has chosen it over others, do some research and therefore and give the money directly after receiving the margin. Somewhere that morphed into trusting the borrower too much. So we said, okay, you produce the invoices and we will pay or we'll reimburse. Now that created the problem, and even for large companies, the last, the 12 major IBC cases, there were a lot of talk of, these steel plants being over invoiced, gold plated, or whatever. But we have seen a major portion of the capitalization is now happened on account of capitalization of the interest in the block. And therefore, the value of the block has gone up, whereas the value of the fixed asset has been low. So, if you take out the interest capitalized, then the value is almost rational. Now, there are, I would say that there are no instances of this, because even at the SME level or the SSI levels, there is a concept of, the suppliers giving discounts and stuff like that. But to handle it through specialized monitoring and creation of a special field force of ASM is to be taking out from the banker's purview what is their job. And it is the banker's job, it cannot be done by policing. We can't outsource everything. Now, obviously, if there is a malfeasance there, the police get into the act, the CBI, CBC, CAG, etc. But, we haven't seen action there. But my point that I'm raising here is that with the GST, you have a better coordinate and a better correlation to actually establish the details. Now, at some point, if I'm just giving a hypothetical example, if you have a compressor with, say, some capacities and some ratings written on the invoice, and the generator or the other compressor is of a lower rated capacity, you are then relying on the discretion of the person who is going to verify. And that same person, how long can you keep checking on? You have a check on that person as well. So at some point of time, you'll have to create a better system. And the solution lies here in not looking at, triangulation of data through GST, etc. is possible, and triangulation of data through the account statements, etc. is possible. But I think we need to shift our focus from our age-old asset-backed lending to cash flow-based lending. And the moment we are able to move to that regime, then our risk is mitigated because we don't lend beyond a certain portion of their EBITDA, 3 times or 5 times. Now, if they are not able to produce the EBITDA, obviously they don't have the machinery and manufacturing, because when you go and realize, you'll always realize it at a discount to what you've done. For working capital assets, everywhere when you have gone and invoked the whatever surfacing, etc., on the working capital assets, what have you got? Nothing. In the plant and machinery, in the shed, etc., what have you got? Absolutely residual value. So while it may be a transitionary concept, but I think it has to be more refined on using technology to triangulate data and to fix the, and that is a much better option, and to move the mindset from asset-based financing to cash flow-based financing.
Sir, don't you think this is actually a theoretical concept in India, and the Indian mindset of an Indian banker is to do more asset-based lending rather than, a cash flow-based lending? Do you think this
So,
will change?
Mitali, this is more born out of our centuries-old, subjugation and the need for control. So we need to get out of that need because in the earlier days, obviously, if you recall the history of Indian banking as well, you will see that there have been various committees from Dahija, Tandon, Chore, Marathe, etc., which are not only said how much will you finance, for what period will you finance, at what margin you will finance, and how you will finance. From those days, then we moved on to more, trusting the borrower. Now that was born in an era of scarcity. You are now going to the market. From control to market is a transition. And in a market, therefore, you cannot use the paradigm which you had in the control era. So at some point of time, you'll have to move your mindset and your distinct to the market. In the West, do they go and check up every asset? They never check up the asset. But they don't lend. Project financing is a specialized thing here, otherwise it's on the balance sheet. So even if a company wants to expand and wants to borrow money for its plant and machinery, the lending is based on its last year's EBITDA. Obviously, they'll have to submit that they have a borrowing base and they have the proof of the material there or the machinery there. But then, do you have specialized agencies to do that? I don't know, because then that sort of thing doesn't happen there. You have, instead of stock statement, you have borrowing based statement. In borrowing based statement, you don't go and verify each and every, counting each and every sack of cement or each and every sack of sugar. We have done that. We have done that in godowns and warehouses. We have climbed up and of sugar stacked in Mr. Pradeep Sethi would know, and counted the bags. But then today, I think it's easier to triangulate the data and catch the the lapses.
Thank you, sir. Sethi sir, I'll take a pause here and would request you to continue.
Should I go for conclusion or any more questions you can ask?
Sir, you want to take it or should I take it forward? I think we are already.
No, I will take one. I'll take one question. Yeah, I'll take just one question.
Yeah.
Shweta sir, we are again talking of Uday. This time another Uday. That is Ujjwal Discoms Assurance Yojana. Now for turnaround of health of Discoms. In 2015, we brought that, hoping that things would improve in the power sector and the lending to the power sector will get some reprieve. And but we know that outstanding payments to generation and transmission companies by state discoms have increased from 41,000 crore in January 2019 to something like 90,000 crore in January 2020. So it's also true that we saw some resolution in power sector under IBC as well as outside IBC. And what's your view? How you think that banks are provided for most of the such exposure stress in this sector? Or how about the stress in the distress in the discoms? What's the, how to get over this problem? What is the kind of problem and how to get over it?
So I'll answer this question in three parts. First part is that the bane of the problem is the control again, where you are allocating, your fuel supply agreement, FSAs are there, and you have your power purchase agreement where you are making sure that these power plant investments don't go waste and they remain viable. That was the promotional aspect of investment in the power sector, right? Then from this control, you have now landed up that your cost of coal is higher than imported coal. Your PPAs, you are subsidizing power, you are actually not collecting power through the rural areas. So you had this Ujjwal Discom and they said, okay, we will convert this into a bond and you must complete a couple of reforms, which means
Steps.
separation of the rural feeder from the urban feeder, smart metering and stuff like that. Well, everybody converted it into bonds, but nobody has done the other part. So net result is that electricity power in the rural area is a hugely political reality. Will it change in the context of India? No, it will not change. That subsidization of power will remain because that's where our politicians will get the votes, and therefore this has been led by, I credited it to Jayalalitha, who was ingenious in giving all those things. But then rest of India, Punjab, Uttar Pradesh, Bihar, everybody is giving free power. So that's a political reality. If you try and charge them for power or do a DBT, it is a transition. So in that context, you will have to find a solution as to how one move the power. You see, right now you have 360 gigawatts of power in this country, and you are utilizing it at almost 50% plant load factor. So which means you have a capacity of another 50%, and at 50%, most of your power plants will not be viable. Some of the power plants which have been set up recently. So when we set up the power plants, at that point of time, the cost was 3 to 4 megawatts, then went up to 5 megawatts, 6 megawatts. But today I'm told that PSU is setting up a plant in Uttar Pradesh at 12 crores per megawatt. Now, how will that be, meet the tariff? And then you have this solar and renewables and the emphasis on renewables, and then you have various reforms which have been brought forward. So the issue here is that how do you make it viable? The viability will come when you are able to charge, where we accept the user pay concept comes. So that is why you will probably see most of the private sector discoms, the discoms in quite a few areas will be privatized. We have seen few instances of privatization. Rajasthan has two places. UP has Agra, for instance. West Bengal has Calcutta and Asansol. Bihar has Ranchi and Bodh Gaya. So you will have Bombay has Tata Power, Delhi has. So you will have this going up. How will that other part be met? The other part will have to be met through DBT, or it will have to be met through cross-subsidization. Now, in the present situation, will you invest in power in this country? I doubt it. Will we need power? Most certainly we'll need power. Once the manufacturing starts in this country, we will be short of power. Will the renewables meet our demand, peak load demands in the daytime? I doubt it. Till we have battery and storage, and so there's now a hybridization policy where you can use thermal, you can use this. So power sector is one sector which will see a lot of changes. And in these changes, should the banks be financing these changes at this changing time? They'll have to be very careful. They'll have to be immensely careful. In the power sector, I don't know. IDBI is probably not financing, but I don't think SBI is also touching the power sector. Nobody is touching the power sector.
Nobody wants power now.
Nobody wants the power. Now, what will that lead to? Again, the market dynamic will come. So, do we get to an era where we have 3 FSAs and 3 PPA, and the power is traded on the exchange? I think you're frozen. Hello, can you hear me?
A slight disturbance is there.
Can you hear me?
Yeah, video is also not coming properly.
So that will be a challenge. And some of the power plants will have a problem. Some of the power plants which are more than 25 years vintage will probably.
Sir, are you able to listen to me, sir? Srivastava, sir? So I'll ask question to Joseph sir first. The last question on this. Yes, it's believed that COVID recovery, people are talking. Some are saying that India is a different and would recover fast, very fast than the rest of the countries. There's other general consensus emerging. People are saying COVID will not go away soon. As Srivastava was mentioning that till injection gets developed and all that. So we have to learn, we have to live with the COVID. So under this scenario, how do you see that, predict the recovery, like U-shape, V-shape, W-shape, or what kind of, what stage we are, what are your thoughts about the recovery from this situation in which we are in at present? Like?
Yeah, just on a lighter vein, I don't think COVID understands the English alphabets. Maybe they could follow some Chinese complex structures. So we don't know what shape they will take. But on a serious note, I think we started with that. Mr. Srivastava and both of us had the view that
Correct.
the trajectory that we are on is very, very uncertain. The impact is very non-linear. The spread is also very non-linear. So at least in India, the problem is we really don't know whether this is a 2 weeks problem from now, the curve will be flattened, or it's going to be for 2 months or even 2 years. We don't know whether the new normal, we are going to continue like this. So it is too premature to say whether it is a V, U.
Sir, we lost you. Samuel, sir, we are not able to hear you.
The demand will come back to the country, as we are a very large country and we are a consumption-oriented economy as well. But some sectors, the resilience and demand could be much quicker, and some sectors could have long-term impacts to that. So we will have to see the recovery not for the economy as a whole, because there will be certain sectors which will recover very quickly. Even now, even during this COVID period, lockdown period, there are certain sectors which are not impacted at all. And certain demand which does not vanish but will remain as a pent-up demand, and when the lockdown is opened up, we will see that demand coming back. So I don't think we need to be too worried about whether it's a U, V, W. One thing for sure, it's a new normal world. We will have to live with this problem for some time. We don't know for what time. But for India, given its demographic profile and the advantages that brings with it, there is no long-term concern for the economy as such, even with COVID.
Thank you so much, sir. Mitali, if there's nothing else, I think we conclude.
Yes, sir. Actually, there is a lot of questions from the audience. So already we are running out of the time, but would like to take 1 or 2 questions. So, sir, one of the question is related to ICA, and the data says that, and this is a publicly data from RBI, that as on June 30th, 2019, the ICA agreement which are yet to be signed is amounting about 33,000 crore, while the agreement which are already signed is amounting about 96,000 crore. However, the resolution plan is implemented only to the tune of 1,600 crore. So, Samuel, sir, what do you think? Is the ICA is a non-starter? And if yes, what is the reason behind that?
Not say that ICA is a non-starter. Of course, you are right that a lot of corporates which had signed the ICA, the July first week of 2019, where about 2,000 crore exposures had signed ICAs, a lot of them were not resolved as of March, and banks have provided additional 20% for that. But I think it is a little unreasonable or unfair to think that within 180 days we will be able to find some long-lasting solution. Yes, these resolutions should be time-bound and it should be enforced on the consortium. But to put a 180-day for very complicated cases, especially for industries, for example, power sector or fertilizer sector, where huge NPAs or huge ICAs were signed, it is very I'll say it is very unfair to expect that within 180 days we will do a change of management, we will restructure under change of management, and fully implement the restructuring plan. The other option available to us under the ICA was anyway to take the company to NCLT. Banks are a little apprehensive of taking such companies to NCLT because we are not confident that we will be able to recover full value, what the asset is otherwise is capable of repaying. So we are still hesitating to refer to NCLT and hoping that some resolution plan will still work out, even in those ICA cases. So it's not a complete failure, but there have been some delays or extension in timelines.
Thank you, sir. And the last question for the session, related to ICA only. Srivastava, sir, since the ICA is not binding to every kind of creditor, can section 230, 232 of the Companies Act can be considered as a potential restructuring mechanism outside of IBC? Sir, we are not able to hear you. Srivastava, sir? No.
No, sir.
I think we are facing some technical glitch from Srivastava sir then. Samuel sir, would you like to take this?
Hello?
Sir, I think we are not able to, we are facing some technical glitch from Srivastava sir's end. So can you take this question, sir, please?
Yeah. So,
Can I request for your benefit?
hello?
Yes, sir, please.
Yes, sir.
Yeah. No, section 230 settlements, I think Mr. Shiva was still speaking, but though we couldn't hear it. No, section 230 settlement proposals, compromise settlements have been happening after NCLT liquidation in quite a few cases. People are trying out for such compromise settlements under the Companies Act after liquidation has been ordered. But I'm not sure whether proactively such settlements can be done. Actually, I don't have much experience on that. Maybe Mr. Srivastava may have because of his experience in Edelweiss. But in the market, in the practical world, we are not seeing too many settlement proposals under the Companies Act sections 230, 232.
Yeah, section 232 does not 230 does not give you the the limitation of time. So it's not it does not enjoin you to resolve the issue within a specified time. It's not so that section 230 to be effective has to be actually there has to be certain changes to that, amendments to that. But more than the ICI, I'm sure you gentlemen would have seen the yesterday's draft circular issued by the Reserve Bank of India on sale of loan exposures.
Right.
So that is a more permanent solution, and the fact that you have imbalances in the security creation in the MBA, multiple banking, or even in the consortium, you have differences based on the reference rate, the benchmark rate of every lender is different, the security is different, the guarantee structure is different, and Mr. Samuel, Joseph, and I have been part of an efforts to resolve the differences among 35-40 odd bankers, and it is interminable. So that's why an ICA was sort of the intermediate step. Now ICA should not come in only at the time of a resolution. ICA should be part of the basic documentation which every bank should join with sign whenever he is giving a loan, whether it's in multiple banking or in consortium. And that's where there's a need for harmonization of the terms and conditions and covenants, where every bank has to go with this through the IBA. So something like in the UK or the United States, where you have common loan documentations, and these documentation, those covenants are sacrosanct. Here, one bank in trying to be more competitive than the other, then dilutes the covenants, and you create a problem in the time of resolution. So I think some amount of standardization in the documentation and the covenants and the terms of conditions is required for every loan that we give, and I think that is being attempted through the draft guidelines which we seen yesterday on the sale of loan exposure. So hopefully that is one step forward.
Yeah. Thank you, sir. Sir, we are actually out of time. Sethi sir, can I request you to provide a concluding remark for the session, please?
Yeah. No, I think we had a wonderful session. And the credit goes to both the panelists who, by virtue of their vast experience, they have very nicely, deftly dealt with the subject, given a perspective to our, the people who have joined, participants who have joined the webinar. And on behalf of RBSA, it's my privilege to express our heartfelt gratitude to them, both Mr. Srivastava as well as Mr. Joseph, for taking out their precious time for the webinar and enlightening the participants and giving them a perspective of the banking scenario, how it is in COVID situation and the post-COVID situation, what is the kind of situation going to be. And again, I'll be failing at my duty if I don't thank the participants who have joined this, for whom this webinar was kept. And thank you.
Thank you, sir. Thank you, Srivastava. Thank you.
Thank you.
Mr. Thank you,
Thank you
sir.
so much.
Thank you.
Thank you, Joseph. Thanks.
Thank you.